The Bank of Canada estimates that borrowers who go to renew their mortgage over the next few years could see a spike of 40% in their mortgage payments, depending on what type of mortgage they took out. In this video, I'm going to go over the Bank of Canada's newly released system review and their growing concern for the increase in the amount of household debt that Canadians are taking on. But before I dive into this information, I would appreciate if you guys could hit that like and subscribe button to help me get my content out to more people like you and keep people informed on the Canadian, the Fraser Valley, and the Langley real estate market. If you guys want to book a call with me to talk about anything that I go over in today's video, you can do so by clicking the link below. It's clear that the Bank of Canada has a growing concern for the amount of household debt that Canadians are taking on. Their recent financial systems report says that homeowners who purchased their home between 2020 and 2022 are on average carrying 17% more credit card debt than those who purchased in 2017 to 2019. Now, this suggests that people that did purchase between 2020 and 2022 are more heavily relying on their credit cards to help get them through this financial strain. Late credit card payments have risen to pre-pandemic levels, but to put this into context, the only difference between now and pre-pandemic was that inflation pre-pandemic was 1.94. Compare that to the inflation rate that is 4.4 today. And the Bank of Canada back then had more ways to stimulate the economy, lowering interest rates. Whereas now, Tiff Macklin said in his most recent report that we shouldn't expect interest rates to be as low as they were pre-pandemic. In the report, we can also see that to date, 1/3 of mortgages have seen an increase in payments compared to February 2022, and that again is just before the bank started increasing the overnight lending rate, doing so 8 consecutive times after the month of February 2022. Now, by the end of 2026, nearly all mortgage holders will have seen their payments increase. So, assuming that rates evolve according to the current market expectations, the median payment increase over 2023 to 2026 period will be about 20%. Now, again, this will depend on what type of mortgage you have, whether that's a fixed mortgage, a variable fixed, or a variable adjusted mortgage rate, but they're saying that the median payment increase should be around 20%. And they are also saying that the majority of Canadians who go to renew their mortgage will do so in the year 2025 and 2026. The Bank of Canada did do a good job of breaking it down further based on the type of mortgage that someone might have. So it says here, for fixed rate mortgages, the average increase in payments at renewal would be greatest in 2025 and 2026 at between 20 and 25%. Now, for variable rate mortgages, the average increase depends on whether the payments are variable or fixed. So in a variable fixed rate, the mortgage amount stays the same. So your payments are the same every month. However, the amount you're paying towards interest versus principal changes based on the overnight lending rate that the Bank of Canada issues. Variable payments for these borrowers have already experienced an increase of payments of close to 50%, with the bulk of the increase taking place in 2022. And again, that's when the bank increased rates 8 consecutive times. Fixed payments, these borrowers will need to increase their payments by approximately 40% to maintain their original amortization schedule, assuming a renewal in 2025 and 2026. So we can see here that the fixed rates are represented in yellow, and in 2022, that's when they were at their lowest point. So we can see those continue to rise as people go to renew their mortgages throughout 2026. And the ones who are going to feel it the most are represented in the green, and that is a variable rate mortgage with a fixed payment term. So the yellow and blue are both fixed rate mortgages. However, the light blue here we can see are fixed rate mortgages with a term of 5 years or more, and the yellow are a fixed rate mortgage with a term of less than 5 years. Now, with what we've just gone over and showing you guys exactly how much people that have a mortgage are going to be impacted financially over the next 3 years, specifically in 2025 and 2026 feeling the biggest hit for most mortgage borrowers, it's going to definitely have some financial strain for people in the economy. We've already started to somewhat see it, but it really is going to start to show over the next several years. Now, it was interesting too because the governor, Tiff Macklin, goes on in his interview to say that we shouldn't be expecting interest rates to be at levels that they were in 2020, and that the mortgage rates we're dealing with today are a transition into the new normal and what we should expect going forward in terms of interest rates.
Going forward, nobody should expect that interest rates are going to go back down to the very low levels that we've seen over the last decade or so. So we're in a transition period to a world where interest rates are going to be higher than what many people have gotten used to.
Now, I know we are trying to fight inflation, so the bank is wanting to continue to increase interest rates. However, with people that have purchased in the last few years, they're also going to feel a great financial strain. And it's kind of like the Bank of Canada is stuck between a rock and a hard place because they don't want to reduce interest rates because that will have an impact on inflation and inflation will increase. However, it is also clear on the other hand that Canadians are feeling financial stress and that we haven't even really hit the bulk of the people that will be affected because again, most people that are going to renew who bought at higher prices but low rates, they're really going to feel the strain. And I think they're going to continue to turn to credit cards as a means to ease their financial stress, and that's never a good thing. The Bank of Canada also pointed out that the decline in house prices have also reduced home buyers' equity for those home buyers that purchased in 2021 or 2022 when sale prices were higher than they are now. So when you go to refinance, usually you have some equity built up because over time real estate in general does appreciate. However, that's most likely not the case for people that purchased in 2020 to 2022. So the Bank of Canada is pointing out that if you are planning on pulling out a bit of equity when it is time to refinance in order to relieve some financial stress, you might not be able to pull out as much as you think you could. And definitely you're going to have some sticker shock when you go to renew at today's rates if you did purchase between 2020 and 2022. Now, what's also interesting is that despite all of this that's going on, currently the real estate market is in a seller's market and it is a hot market. I spoke last week in my market update that we are seeing multiple offers throughout the Fraser Valley and Langley area. So definitely people are still purchasing homes at today's rates. And that draws back to the lack of supply that we have. Obviously, there's Canadians that are wanting to purchase in the Fraser Valley and all parts of BC and Canada for that matter. Vancouver and Ontario are always the hot spots for the Canadian market. And Ontario, specifically Toronto, is seeing patterns similar to those that we're seeing where it is a seller's market. They're getting multiple offers. So it just doesn't really make sense with, the news that we're hearing with what's to come, that the consumer confidence is still there in the local markets. In the Bank of Canada's release, they spoke about lengthening the amortization period of a mortgage term, which reduces your payment, but it also stretches out the term, so it takes you longer to pay off your current mortgage. They were definitely not in favor of that being an option for Canadians who are getting into a new mortgage. However, they said if you're in a current mortgage and you need to extend your amortization period to minimize your mortgage payments, that would be allowed. According to the Bank of Canada, the share of mortgages that have an amortization period of longer than 25 years rose from 41% to 46% over the course of 2022. Put that into context, in 2019, mortgage borrowers with an amortization period longer than 25 years was only 34%. The next rate announcement is going to be on June 7th. So obviously we never know if they're going to increase the rates, keep the rates the same, or reduce them. It's kind of a split right now between the Bank of Canada keeping them the same or increasing them by 25 basis points. But one thing is for sure that Tiff Macklin has made it clear that we shouldn't expect rates to get reduced anytime soon. I know this is a lot of information and it might not be the information that you guys want to hear, but one thing's for sure is that I just want you guys to start preparing now for the inevitable, which is that your mortgage payments will increase, and that's again whether you're on a fixed or variable rate mortgage. I hope you guys found this video to be helpful. Again, it's probably not the news you want to hear, but it is the reality and we have to start planning in order to better prepare ourselves. If you guys did enjoy this content, I would appreciate if you hit that like and subscribe button. Reminder again, if you want to talk about anything in more detail, you can do so by clicking the description below to book a private call with me. I hope you guys have a great day and I will talk to you soon.